So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all the way to help MVPs. My name is Brett Swarts. On every episode, we are joined by some of the world's top entrepreneurs, millionaires or billionaires, and they share their secrets, wisdom, and insight with us so we can all level up and make a bigger impact. I'm excited about our next guest. He's out of the Indianapolis area, and he is a partner at Resolute RDM. It's a real estate firm specializing in commercial investment and property management. Over 17 years of experience, and he's a CPM, a certified property manager, and a CCIM candidate designation as well. He brings extensive expertise in income-producing assets, investment strategies, asset management, syndications, ground development. He's a real estate pro, is what we're talking about here. Please welcome to the show with me, Ryan Cadwell. Ryan, how are we doing?
Good, Brett. Thanks for having me. So excited to be here.
Absolutely. And for our listeners to get to know you for the first time, maybe just give us a little bit more about your story and your current focus, and then we'll dive into how to build some wealth in today's market with property management.
Sure. I grew up in the business. My dad owned some affordable apartments when I was younger. So just cut my teeth mowing grass, changing toilets, doing the stuff you got to do when you're a newbie, and grew that into a several hundred property portfolio, and then have just been leveling up ever since. Switched from did a couple hundred flips. Didn't necessarily like not being able to control all of that, so then got into ground up development, and then that's migrated into some of the bigger projects we're a part of now.
Excellent. Yeah, that's great. And so let's dive right into it. What is the number one thing you're seeing for maximizing property management in today's marketplace? I feel like there's lots of changes that are all kind of hitting at once, in a lot of ways. Of course, it depends what market you're in and what you're managing. But what are you seeing right now that your investors and or the owners that you work with most appreciate about what your firm is providing?
Sure. I mean, I think the main thing we provide much more of a proactive approach, proactive strategy as opposed to reactive. Anybody knows that reactive usually can cost you more money. The proactive approach has more to do with buying right, making sure you know what you want, why you want it, and then build a plan, and we execute the plan, as opposed to just flying by the seat of your shorts, and just trying to figure it out as you go. Let's build something together that's properly underwritten, with proper assumptions. Know where we got those assumptions from, and then execute as best you can with the things you can't control. But I mean, the main thing that a lot of the things we're getting brought into is just it totally depends on the asset class type. I mean, office here in Indianapolis, there's a lot of flight to quality, so your BC assets are going to have to be repositioned in a different way. Multifamily here, tons of delivery on new units, so that's creating downward pressure on your B and C quality units. totally just depends on the asset type. It depends on when you bought it. Depends on if you've got any of those interest rate pressures, how leveraged you are, all those different kinds of things. So whenever we get involved with somebody, it's learn who they are, learn what they did, and build accordingly.
Yeah, I could agree with you more, Ryan. And by the way, you can learn more about Ryan by finding him on LinkedIn. And Cadwell is spelled Cadwell. I feel like there's three things to every deal, and whether it be management, whether it be acquiring, whether it be exiting, and there's cash flow, which most people know, right? But there's also tax flow, and the third one is also debt flow. I think a lot of people got, maybe a little bit too comfortable with thinking that interest rates would be down or low for I had one client tell me, oh, they're gonna be low forever kind of thing, right? So I call that debt flow, and they take that for granted, and obviously we're seeing the consequences of these resets now. Tax flow, they're like, hey, I'm gonna buy all these deals because I got this 100% bonus depreciation, and if I don't buy it now, next year it's gonna be 80, and it's gonna be 60, and so that was driving some of this their tax flow I can offset, and just and then you have cash flow, which you had these double-digit rent growth in a lot of markets across the country for many years, and it was like, man, this thing is just sweet. It's gonna keep growing. I remember sitting back going, this is a little crazy. This reminds me a little bit of 06, and 05. And we have a strategy where we can help people exit and defer tax and not have to deal with 1031s and all this stuff. But I'm curious, going back a couple of years, being in the property management business, what was your feeling in your gut of before 2022?
So, well, before 2022, it was, holy shit. Like, how do we stay on top of all the changes that came out of COVID, just from an execution standpoint? But the bigger thing with what you alluded to, especially with people that thought debt was never going to go back up, what other direction could it go? I mean, the only other way it could go is up. So, I mean, I spent a lot of time going and talking to my lender partners. I had other brokers in the market. I was asking them questions like how are you guys doing this, and why are banks underwriting some of these? To me, it seemed like a bubble because everything was just so good. Like, how could it possibly be that good? And then the other flip side of that is when your cap rates kind of bottom out and hit a floor, and that's where all valuation's coming from. What's the next realistic move in the future? Like, cap rates are probably going to go up. When that happens, you're going to squeeze equity. So for me, I mean, I was interviewing tons of people, taking them to lunch and being like, this just doesn't make sense. Why are these being underwritten like this without more equity needed down? Because of being purposeful and knowing that you're gonna have a squeeze on that cap valuation. And it's one of those things where I kind of got told that most lenders are publicly traded. They care most about how that stock price is. So if loans is driving revenue, and they don't necessarily care about the UW on some of those things. I felt like we're a little bit, well, they were flat out overpriced. And I think you're starting to see more of those promised returns are starting to squeeze. And I have heard from other CPMs in the marketplace that some of the bigger outfits that, they're trying to operate these properties with extremely limited budgets, even budgets that weren't realistic. They were financially modeling things, removing specific pieces that property managers wanted to have at their disposal to be able to maintain property values, not have tons of deferred maintenance that's going to impact valuation on disposition. So, I mean, watching all of that, it's been more of a lesson in fundamentals. Like, the fundamentals don't change, and when it feels too good to be true, you probably, like, we need to apply our own self-discipline, right? Like, underwrite it as if, like, we were given a gift and this gift is, has a finite end to it, which we all realized.
Couldn't agree with you more, right? And there's deals that we still didn't get completely out of multifamily. We still have some clients take some positions and some deals that have now been completely lost or on the verge of, I call it the jujitsu tap out of 2026. Like, we thought it might have been 2025, but really it's 2026. And now, like, people's arms are getting snapped that they've been trying to hold back. And so it's happening, and they're losing to the banks, or they're just completely selling all of their equity stack to a preferred equity partner. And it's painful. But I think the developer's number one mistake that I found, or even just investor, is exactly the mindset that things are going to continue as they are and not preparing, and basically, staying in, right? When I had one client, he was pretty smart. He goes, "Brett, I always get out, when there's still some meat on the bone. And I never get in until, like, I let the sharks feed at the bottom. I like to kind of play the middle, let it feed and let them get all the really when and it starts to come back up to, I feel like the momentum is coming back up. Then I jump in, and so it's kind of like this, think of it like a 20-60-20 model. Like, I don't want to get in the bottom 20. Like, I don't even want to risk that. I like the middle 60, and the top 20 gets frothy. I'm out. I don't need to wait for the height. And the developer's top mistake or investment mistake is not having an exit plan that gives them cash flow, debt flow, and the ability to have timing, tax flow for investments. And it's just painful to see, because I was at Marcus & Millichap in 2008 when this happened, and we didn't know a solution except for just the 1031. That was kind of where we thought it was at. But the problem is you're typically selling and buying in the same market, or if you're the developer, you've built this amazing project, you've maximized this value, and you're like, do I want to just turn around and pay tax? Well, if you think about it, it probably is better, because you can just turn around and go build another project, right? It's going to take a couple of years. But the 1031 oftentimes forces people, well, I don't want to pay that tax. Let me just jump it into this other one. So I'm curious, what is your biggest frustration with the 1031 exchange, especially from a developer standpoint? Because I know you're building that deal in Missouri. We can talk about this build-to-rent, community. But if you sell it, you got to buy equal or greater value within a 45, 180 period. And if you're buying bare land, it's certainly going to be as expensive as the property you just sold, right? So walk us through a little bit of that mindset with the 1031.
I think the biggest thing with 1031s that I even learned myself by doing it wrong is that the main thing I did wrong was I thought I always needed to do it. Like, there is a financial calculation to where you're like, no, I'm going to pay my tax because of where the market's at right now. For me to go laterally makes no sense. So like, with over the last 4 years, we've had a lot of conversations with our investors of whether or not do you even 1031, or do you just pay your tax? Because right now, set your investment criteria, know how you got to that. If you don't have assets that meet that, don't be afraid to pay your taxes. Like, especially if your returns are 10, 12, 15%. I think when you actually do the math, I mean, everybody's afraid of paying the tax guy. It's like the boogeyman, as opposed to, no, taxes is just part of the deal. You don't want to pay them if you don't have to pay them, if there's a strategy. But if by you avoiding taxes puts you in a bad deal, you still have the taxes to pay, and now you have a bad deal. You have both. Now you may, and at the end of the day, taxes are only a percentage of what you made, as opposed to losing. You could lose all of it, I guess, technically.
Honestly, that's what we're seeing, right? We're seeing people who overpaid, had too much debt, too much liquidity, not enough diversification. I'm sorry, not enough liquidity, not enough diversification, too much debt, all illiquid, and now the ship can't turn fast enough, right? With the Titanic, and there's the iceberg ahead. So we do have a solution. I'm gonna run it by you, right? Because you're CCIM, and I started at Marcus & Millichap, and I've done this for a while now. So we use an installment sale with a trust, Ryan, where a business, real estate, Bitcoin, doesn't matter what it is, it can exit with no timing restrictions, no 1031 required, no debt replacement requirement, which is the most kind of sneaky part of a 1031. It's not just equal or greater value of the sales price, it's equal or greater debt, right?
Yeah.
And so these 3-year arms that have, adjusted and now have shot up, that's what's sinking chips. I do analysis of all the deals that have been lost of these multifamily deals. And I asked the sponsor this one thing. I say, hey, if you would hit your plan perfectly, meaning you got the rental increases that you projected, let's say it was 3%, your insurance had stayed, approximately about the same cost, or even if it had gone up, you had did 95% plus occupancy, you ran your property management there, and I asked the same question, and only thing that changes is the debt, would you still have lost your property? And I think I've got a 99% response, yeah. Like, it was insurance. It was, of course, the debt. It was, lack of rent growth. It was, we weren't maybe running as well as we could have or should have, or didn't hire the right group like you guys to run it. But at the end of the day, like, things really slowed down. But even if we hit all of those perfect, except for the debt piece was still the overwhelming number. So in my mind, that debt flow, we have to discipline ourselves to get out of it when the things are so hot and so high, right? And or fix it for 10 years. I mean, the hard part is, unless you were like a multi-billion-dollar, let's say, group that can negotiate the banks with all of your assets and fix it, a lot of the banks weren't willing to do that. But if you can fix it for a 10-year term, then you can remain. So that's my part. And so our solution is an installment sale with the trust. I'll give you a case study on this. We had a client, it was like 2021. They sold it a car wash in San Diego. They built it for $4 million. They're developers, by the way. That's their number one way they make money, is they develop it. Well, within a year and a half, the value went to $13 million. Right? And so it didn't make any sense for them to buy a $13 million asset and that same marketplace take on all this debt when they already knew it was high. So they were either going to pay the tax or use our strategy. And what was cool is we paid off all of their debt, we diversified all of their wealth, and we deferred all their tax. And then the money sat in Schwab, and we went mostly into real estate debt positions, okay?
Yep.
And we got mostly double-digit returns, all tax deferred. Bought some hotels at a discount because there were some hotels that were kind of, just recovering after COVID and all that stuff. So we got some deals there. And we've been in this waiting pattern really for the last, 3.5, 4 years. And we're like, okay, let's just wait. And now we're finally seeing the values of land start to decrease substantially enough to make sense to go back in. Our strategy allows you to still defer the tax and still buy and still be a developer. All tax deferred. So it's kind of like a self-directed IRA. Like, you set this thing up, It comes in, it can go in and out, all tax deferred. Anyways, this is why we do what we do. But I'm curious, have you ever heard of something like that, Ryan, and not having to use the 1031?
Yes, actually, I was just on the phone with a potential future client. I was talking to him about DSTs as opposed to just the 1031 that someone else had told him about. Yep. And I was like, well, if there's nothing else, and walking through the same strategy you just went over, and I was like, there's a way to do this over time. There's a way to do this, even if part of it went to the DST, part of it went in, we can be as creative as we want. Yeah, I mean, those solutions just aren't as well known, and really wish that they were, mostly because, I mean, you worked at Marcus, like, it's better for us to transact, right, as opposed to yank it. But yeah, I mean, our position is more advisory, consultative, to where less about the commission, more about the long term game with our people. Nothing wrong with that. Transaction has a place, but yeah, I mean, DSTs are an amazingly creative tool, especially with the right people that know how to use them. And I mean, you mentioned Schwab, and I've talked to a couple other people in that world that are doing it, billions of dollars worth of DST transactions right now.
Yep, absolutely. And just clarify everyone too, because DST has two different ones. There's a Delaware Statutory Trust, which is known as a 1031, and there's a Deferred Sales Trust, which is the one I was referring to, which is an installment sale with the trust that allows for businesses, Bitcoin, real estate, and it can also save a failed 1031. And then Ryan's exactly right. Sometimes we do a 3-part. Like, we had a Texas deal, $6 million, did a partial Delaware 1031, Delaware Statutory Trust, a partial Deferred Sales Trust, the one that we do, and a partial regular 1031. And so you can have a hammer, a screwdriver, right, a saw. Like you need different tools to solve different parts of what you're trying to accomplish, and that's really the key here. Like have a three-dimensional type of approach for investing: tax flow, cash flow, tax flow, debt flow, and also a three-dimensional type of way for moving to the next one. But I think the most important thing I've learned in this, Ryan, from the '08 crash, and let's call this the 2025, 2026, multifamily downturn, right? I don't know if you want to call it a crash, but maybe it is eventually. Consider that. Yeah. It's time. You got to have time on your side, and you got to have the ability to have some liquidity on your side, and to get out of debt. I'd say in that order, right? Get out of time, and then liquidity and debt, and if you can get that in your favor, check, man, you're a way stronger leverage position than just the opposite. No liquidity, timing's not on your side. Having to stay in debt, you're kind of handcuffed in that marketplace. If people want to learn more, go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Okay, let's keep going here, Ryan. Talk about Missouri, that deal that you're working on. It's built to rent. Talk about any other deals that you're working on that maybe if an accredited investor wanted to work with you, Ryan, out of Indianapolis, or different deals you're working on. What does that look like?
Yeah, so the one in Missouri is 242 unit. We're working with the city. It's a blue collar distribution, transportation distribution town, Lebanon, and it's a 3-year project, 3 phases. Right now we're in phase 1. That'll be 50 total buildings, 100 total units. We're expecting that to be done in about 18 months. Return on that is projected IRR at about 18.5% to 20%. If you're interested, reach out, give me a call. Let's have a conversation. The other thing we're doing around here, we're working on a new concept within the industrial space in some of our growth markets right now. I'll be rolling that out on our website. Don't want to deep dive that quite yet publicly, but it is an industrial play. It's meeting the market needs. I think projected returns on that are, right in that 17 to 19 range right now. Until we get a few things locked down, can't really expand on that, but it is a small bay industrial.
Love it. I love industrial. Yeah. And I love the build to rent concept. So it's duplexes, right? That's what you're building there in Missouri.
Yep.
Yeah.
Yep.
And then you say three-year project to building it all fully, mostly rented out. And then do you plan to sell it in 3 to 5 years, or just continue to hold? What's kind of the general?
So that particular that's actually the one in Missouri is actually both, because we're working really closely with the city. The city specifically said they wanted us to help answer the affordable housing product need that they have. So we're very purposeful in that we're building them all in a similar way. They'll have their own colors and everything on the outside, but some of them are going to be available for sale. So if you bought, say you bought 20 of them and you wanted to sell 5, you could technically do that. The city wanted us to be able to provide that community with both things they could own and things they could rent. So right now, we're answering that need, and we're planning on operating phases 2 and phases 3. Potentially, could be some TIF dollars in that. And then phase 1 is going to be mostly all sales, but plan B for us is to rent them, get them operational.
Let me give you a little tax tip that you may or may not know of. But, one of the best, most flexible ways to structure these types of deals is an LLC tax as a partnership, because you have multiple partners, right? Yep. And then you can assign your interest, as an example, to a trust. And as you sell in tranches, like those first 20 or whatever, even though you're paying off the debt, the tax is still deferred. And I've worked with developers in the past, and then eventually you sell out of all 240 and you have this pile of cash, but it's all in an installment sale, right? Versus having to try to, typically you cannot 1031 unless the whole entity moves and all the partners move all at once. This is a nice way to strategically exit in tranches yet still maintain the tax deferral along the way. Just a little bonus tip, on there. And usually we don't geek out so much, but your CCIM and your background with management and development and investments is kind of unique here. That being said, any other, just thoughts on the market or things that you're seeing? Like, what's your sense of where we're at? Anything else you want to add before we go to the lightning round?
Sure. I think one of the things that it didn't totally surprise me, but if you were watching BlackRock and when they were exiting, they were exiting last year out of their big SFR portfolio. They were building up cash, and then they went through some fundraises. And then this year, everybody was expecting more people to start buying that commercial asset, the distressed stuff. And instead of buying them, they're just going straight for the loans. They're just cutting equity straight out. I mean, I think like once I saw that, I was like, okay, this is really this was really the wave that was being created between 22 and 24 is somebody coming in and just saying, well, I don't really want to deal with all the equity people. I'll just buy the note, and when we foreclose and we've got the asset. So just keeping in mind that strategy is out there, and that there are people that use it, know about it, use it, and they just use it when the market presents the opportunity.
Interesting. And you're saying specifically they're doing it with like retail or office, industrial, and multifamily, I imagine, BlackRock.
Some of the sources that I've been reading, they're going straight for the notes, the distressed loans. Yeah.
Any distressed notes, basically anywhere in the commercial world, whether it be multifamily, large or retail or industrial office, it doesn't really matter. They're just like, let's just go straight for the notes because we think they don't have the ability to do the capital calls for their investors. That's dried up. And the banks may or may not want to have to deal with it. So let's just, we'll buy it and we'll wait. We know there's enough equity in the deal to service our note, or at least to recover our note, but hopefully there's some extra layover and we'll get the bonus on top of that. Is that a fair summary?
Yeah. I mean, they're essentially using that as a way to realize a corrected value. Mm-hmm. I mean, they're correcting valuation through that acquisition process. Mm-hmm. Yeah.
Fascinating. Thank you for sharing. That's a good insight. And I guess it's good to pay attention, right? Like if BlackRock is getting out of SFR last year, right? You might say, okay, it's like kind of follow Warren Buffett a little bit, right? Be like, okay, they know something. How can I de-risk my positions in SFR, right? And so, but that being said too, every deal and every market's specific, right? I mean, you're building these the duplex B2R, so it's not that simple, but okay. That being said, let's move to the lightning round. You ready, Ryan?
Sure.
All right, maybe the number one book you recommended the most in the past year.
Obstacles Away.
Excellent. Question number 2, what are you most curious about right now?
Most curious about right now. How the market is going to continue to create wealth in a much more healthy way, where people are less stressed.
Yeah, for sure. And given AI and all the things that are going on there too, right?
Yeah.
Yeah. This world is a different world right now. Next question. Number one leadership quote or theme that you strive to live by.
A ship with no port. For a ship with no port, no wind is favorable.
Oh, that's good. I like that.
By Seneca.
Okay, excellent. Question number 4. Top way you're using AI right now.
I actually have built tools for financial analysis, and then I have my own executive assistant built into my AI.
Excellent. Last question, and we'll wrap it up. After all your success helping all the people you helped, what's the best way that you keep a mindset of stewardship over ownership?
Oh man, I mean, life's just so short that it really is about the relationships and the value you bring. I've just found so much more. It's so much more fun to. Sure, you want to count money and that's points, but it's just way more fun to engage with people and walk with them wherever they are, meet them where they are, walk with them where they are on the journey. there's always opportunities to make money. The biggest thing with making money is you just got to know what you have to mentally know what to say no to. Yeah, I mean, adding value and finding ways to just improve, improve the relationship people have with real estate by creating proper plans, assessing the thing clearly, being proactive over reactive. Yeah.
Amazing. Ryan Cadwell, I want to thank you for being on the show, sharing your wisdom, talking some tax flow, some cash flow, some debt flow, some 1031s, some DSTs, all of the above. I want to encourage you to keep using your gifts and talents to bless and help people make wealth and help with the affordable housing crisis by building and managing properties. Top crisis in the world and one of the top in the U.S. And so keep doing what you're doing. For our listeners who want to get in touch with you, one last time, Ryan, what's the best place for them to find you?
LinkedIn or ResoluteRDM.com. Resolute RDM. Some people say ResoluteRDM.com.
Perfect. Awesome. Thank you, Ryan. I also want to thank all of our listeners, our viewers for watching or listening to another episode of the Building to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels where you can subscribe and for more content like this. Hey, we're on this journey with you to scale from millions to billions so we can give more all the way to help MVPs, the most vulnerable people. Like Ryan said, time is short, right? Life is short. Don't take for granted the opportunity to make an impact today. If you have a large exit, Bitcoin, business, real estate, and you're wanting to defer capital gains taxes outside the constraints of a 1031 exchange, go to capitalgainstaxsolutions.com. We also have a book we came out with Kevin Harrington from Shark Tank, which is pretty cool, called Building a Capital Gains Tax Exit Plan. Appreciate you listening and watching out there, and we'll talk to you again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.